Greetings, Jonathan. Camarda, as we roll through Q1 2025. Here we are in February. So I want to start with, again, heavy heart here, as it has been a lot of tragedy this week. So I just definitely want to take a moment there to say that prayers to all those affected from that standpoint, as it has been a tough week here in the U.S. The week started with a bang, though, didn't it? We had the DeepSeek. Was it deep fake? Tough to tell. Nobody plays that on the river card better than China. So we shall see the decreased cost of AI and the technologies, how that affects the technology companies here without getting into details, and what they've been spending. Tough to tell. We saw an overreaction potentially in the market, and when we look at the National Association of Active Investment Managers, just their exposure to equities, they definitely reacted. They went from 85 to 68%. Nothing that drastic here. We put on little hedges without getting into too much granularity there, but continue to stay pretty opportunistic, because if you look at the S&P and NASDAQ, continue to be above its 50-day moving average technically. The Dow Jones, which took a little dip there during the end of the year below the 50, above the 200, bounced back above as well. So all three are above the 50-day moving averages. And then when I look at confirmation of Russell 1000 growth versus Russell 1000 value, that's in an uptrend. A little sideways here recently, so you have to watch that, but still in an uptrend. Again, that's generally pretty bullish. Some of the other ratios looking at as well, gold has been attractive, so we've had it on some of your strategies and added positions. We look at gold versus treasuries, outperformance gold versus the equity markets as well, pretty attractive. So we want to have exposure there as well from that standpoint. Sector-wise, when we start to look, again, the best performing sectors rolling 3 months, 18 months, really the last couple of years, discretionaries, communications, and financials, right? Over the last year, utilities are in there, number 4, do have to mention. Technology is kind of in mid group there, and over the last 18 months, really sideways versus the S&P, while again, communications, discretionaries, and financials, really the only sectors positive versus the S&P since mid-23. Just saying. Now, the worst performers at the end of the race there, at the end of the F1 line there, we're looking at, again, materials and as such there, real estate. Healthcare it's climbed out of the basement, and consumer staples. Think your household names, without getting into details, the worst performers. And we always want to watch, when you talk about value investors looking for high dividends or low PE ratios, that is pretty dangerous in this environment, because a lot of those companies, we start to look in the books, their ability to even keep paying those dividends, what their cash flows are, income statements. Just definitely want to proceed with caution for those folks out there that like to go in value from that standpoint. Okay, so as we move past that, as we get kind of to the global macro here, we're going to go fixed income, right? We're talking about the yield curve forever. A skier's dream, Aspen, here we come, right? It's been inverted. 2-year, 10-year, 2-year higher than a 10-year, higher than a 20-year. Well, last November, things changed, and into December, it flipped. We have had an incredible steepening. Turn the skis in for hiking boots. We're looking at Everest now, 2-year at about 4.22. These are, again, approximates. 10-year at about 4.58, with the 20-year at about 4.88, actually a little higher than the 30-year. Now, how that compares globally, only Great Britain in the developed countries there at about 4.5 in the 10-year, which is a little surprising given the ECB, European Central Bank, has been really dovish. Most of the European countries, low single-digit yields, of course not as low as Japan, which is why we had that unwinding in August. We shall see what the BOJ does, as we've had, again, very low single digits for Japan on their yields from that standpoint. So very interesting, right? So over the last several months, of course, these short-term treasuries have been outperforming long-term. Makes sense. Year-to-date, though, long-term is starting to outperform, but it's too brief to really take note of that, except I guess I just did, something that we are watching. Now, in the credit markets, best performers the last year and plus, again, has been your convertibles, your high-yield bonds, which makes sense during a bull market, right? Because both of those have more equity characteristics, and as such, their preferred's not too bad as well. So we're watching that. From a macro standpoint, we have had certain clients talking about, debt per GDP and all that. U.S. obviously pretty high, per capita, pretty high percentage that we want to watch there. I think it's at Italy's level, from that standpoint. Always been the case. Major delineation, we still have the global denominated currency. There are some changes there over the last few years, but that's been trickled off. Nothing major yet. We always keep track of that, however. Now, as far as a lot of talks of tariffs, we don't get into the politics here, but as far as tariffs, that affects what you call, trying to contour what they call the current account per GDP. Current account for folks out there that are not masochistic enough to keep up with that. Imports versus exports. We're at negative 3%. Doesn't sound too bad, except that's one of the higher ones. And actually, Great Britain, mention them again, they're actually a little higher than us in the threes as well, but they don't really export much. I don't even know if the Jaguars still come from there. So, again, that's, the highest GDP surpluses are Germany, right? Makes sense. And Japan, China. But number one, drum roll please, can we get a little Jeopardy music? What is Switzerland? Because nobody loves watches and chocolate more than the Swiss, and apparently everyone else as well. So there you go for a little trivia question. So as we move along on the currency front, as we go through our macro playbook here, the US dollar, which has been just killing all these other currencies, the euro, the yen, the pound, right, the Aussie dollar, Canadian dollar, you pretty much get what I'm saying here. We've seen a little softening there recently, maybe just a little dead cat bounce. That makes sense with the yields coming off and longer-term treasuries doing well. What all this means is, again, we just want to see if there's any shifts if we need to, again, change allocations. That's what it means to you. So we have to keep our head swiveling on that. Lazy Susan going about 99 miles an hour, going to almost be Linda Blair there to keep up from that standpoint. So we are definitely watching that. Now, as we start to look again, what all of this AI stuff means, nobody knows. So even on TV, you have prognosticators, most of them that are smart, right? They're even saying you don't know yet, so you don't want to take major action on that. You want to watch with caution. Is less cost possible to actually produce very, very high performance? We have all these data centers we're building and all that. A lot of domestic companies spending a lot of money. We shall see. Is it overdone? We don't know. Is that on the river card a three of clubs, or is it an ace? We don't know yet. So we have to watch for that. Now, I do want to do a little of housekeeping as well, as it is the beginning of the year. Always a good time to remind, as I do with my clients and your personal wealth advisors do with you as well, is your estate planning. Start to look at the beginning of the year, as again at the taxes, right? How you can save on taxes, sculpting that in with your estate planning, trusts, asset protection, LLC, stuff like that you want to look at. Good time of year to kind of make that to-do list, as well as if income needs, financial planning needs, family needs that have changed, that again definitely take precedent over our models, because it's based upon what you need out of your investments, which you earned. Certainly want to discuss that to make sure, if changes in the models beyond the macro picture I just went through, if you're still awake, certainly let us know on that as we try to bring that into communication as well. Also like to ask what you've been happy with over the last year, what you would change just in the way we structure our service. Sometimes we're remiss, we get into all this, all this quantitative stuff, want to qualitatively say that anything that we can also do to improve the service for you, because we do serve you, right? We take off the is, it's serve and serve you. Again, heavy heart, tough week, just a lot of stuff happening. So prayers out there from that standpoint. As far as the markets, we will stay eternally vigilant. You have one job to do besides communicating with us. Stay frosty. And until next time, it's a pleasure. Jonathan Camarda.